Now, what if I told you buying a property can actually make you poor? Now, it's very common in real estate for investors to use leverage, meaning they put debt on a property to ultimately increase the return on investment. But if people buy a property and the debt that they're getting for the property has an interest rate that's higher than the cap rate, then it can become an issue. This is called negative leverage, and that's the topic for today's video. My name is Sitan Dabuya. I'm a multifamily consultant and investor. I help people acquire and develop commercial real estate assets. Now, is a commercial real estate property an asset or a liability? In some sense of the word, they're actually all liabilities, but beyond that, if we're talking about does a property create cash flow or does it take money from you, that's what we're talking about. And the answer is it depends. So if you're buying a property with negative leverage, you might be buying a liability instead of an asset without even realizing it. So negative leverage, as mentioned in the intro, is when you have an interest rate that's higher than the cap rate. Today I'm going to be covering what negative leverage is, why it can be an issue, in which cases it may make sense, and what to do if you're looking at acquiring a property with negative leverage. First, what is negative leverage? In order for you to understand negative leverage, you must first understand what a cap rate is. So a cap rate is a common commercial real estate term. It's essentially the unlevered rate of return for an asset. And unlevered means no leverage. So if you buy a property without any leverage, without any debt, essentially you just buy the property straight out cash, what is the rate of return that that property is going to give you? That's your cap rate. All right, now put that to the side. So negative leverage is when you buy a property and the interest rate of the debt that you put on that property is higher than the cap rate, which means you're essentially borrowing money at a higher rate than what the property itself can produce in return on investment. Now you can see how that could be an issue. You're borrowing money at a more expensive rate than what the property can give you. That can lead to issues where your debt is more than what the property can actually cash flow. All right, now let's look at a quick example. Say you're buying an apartment complex with a 5% cap rate and a 6.5% interest rate. In this case, the return on investment is lower than the cost of borrowing, meaning every dollar you borrow is costing you more than the real estate is making, meaning the debt is hurting you more than it's actually helping you. So why is negative leverage bad? And the main reason is that it actually defeats the cost of borrowing in a lot of sense. So a lot of times people are borrowing because the debt is supposed to increase their return on investment. Because if you can bring more cash to the table or bring less cash to the table, that's going to improve your return on investment theoretically. Now, debt equals more risk. Always. Every time you take on a loan, you're increasing your risk because now you have an obligation to pay back that loan. Now, it's okay to take on that risk theoretically if it's going to increase your return on investment and you mitigate the risk so you know you have cash flow to pay back the loan. But in a negative leverage situation, now you're in a situation where you're taking on more debt, but instead of increasing your cash flow or increasing your returns, you're reducing it. At the same time, you're increasing your expenses because now you have a mortgage. And if you have a negative leverage situation, your mortgage might be more than the property can actually cash flow. All right, now let's look through a couple examples. So these are going to be very simple, rudimentary examples to illustrate a point. But first, before I get into the example, if you're getting some value out of this video, please go ahead, like, subscribe, leave comments. Always look for feedback and yeah, be able to find out about more videos coming up. All right, in this example, you're buying a $10 million property with a cap rate of 5%. That means the net operating income is going to be $500,000. Now, let's say you get a loan with 75% LTV, which means your loan amount is going to be $7.5 million. And that loan has an interest rate of 6%. So in this position, you are in negative leverage because your interest rate is 6%, whereas your cap rate is 5%. As you can see, just based on the projected loan amount and the cash flow or the NOI, you're in a position where you're losing money. This is on an annual basis, but you're losing this amount of money every single year just based on the property and being in a negative leverage position. Now you can see how dangerous negative leverage can be. You bought a $10 million property just to lose $40,000 a year. You did not buy this property or buy this investment and then have to go through all the work of operating this property just to lose money every year. That's the issue with negative leverage. You're in a position now where you're losing money because the debt on the property is too expensive. You're paying more than what the property can actually cash flow. Now, that's why most investors you want to stay away from negative leverage And there's very few situations or very few investors that you can look at a negative leverage deal and still want to pursue it. Now let's look at another example, another scenario. So a lot of it will be the same stuff, but it's going to be some minor tweaks. So in this situation, you're also looking at a $10 million property and it's at a 5% cap rate. And in this case, this is a value add play. So even though we're purchasing the property at a 5% cap rate, we anticipate through, actual strategy and being able to implement a strategy and not just depending on the market, but we're anticipating that we can get from 5% to 6.5% cap rate. Let's call that, say in the first 2 years, just to be conservative, to give you enough time to implement a solid value add strategy and be able to increase revenue to get to that 6.5%. Also, in this scenario, you're able to get an interest only loan. So that means you're not going to have to pay principal for those first couple years and you'll be interest only. So now your debt service goes from $540,000 a year to just $450,000 a year during that period when you're trying to stabilize the property. Now, this is important because now you're able to cash flow with an NOI of $500,000. Even though you're still in a negative leverage position, because you're interest only, that allows you to have a lower debt service, which allows you to cash flow during the stabilization period. Now, by year 3, you're able to be stabilized, and now your NOI has gone up to 650,000, meaning your cap rate is at 6.5%. Now you're in a positive leverage situation. Now you go from scenario one where you're losing $40,000 a year to now in year 3 you're making $110,000 in profit. Again, this is a very simplified example, but it illustrates how one can go from a negative leverage position to where they're losing money every year to being more strategic and having a value add project where there's upside and you can increase the cap rate to now they're able to cash flow after implementing a value add strategy. It's worth noting that this is incredibly risky. It's very risky and it takes experienced operators to be able to go into a property knowing that they can actually be able to increase the revenue, decrease expenses, whatever combination is to be able to increase NOI. It's easier said than done. And a lot of people, a lot of investors will go into a project expecting to do just this and they do not execute. And we've seen it time and time again, and they're in a negative leverage position thinking that they're going to turn it to positive leverage, but things go awry, and then 2 years down the road, they're giving that property back to the bank because they weren't able to meet debt service. It's incredibly risky and takes a lot of skill to be able to execute this. Now, with that being said, when does it make sense to buy a property with negative leverage? Now, there's a few cases, assuming you're an experienced investor or partner with an experienced investor, where it does make sense to go into a property with negative leverage. One is going to be value add deals. So properties with a good amount of upside. Rents may be $200-300 below what the market is, or there's like demonstrated ability to increase the rents of that property so you can get that NOI up and get that cap rate up relatively quickly. You don't want to be in a position where it's going to take 2, 3, 4 years to be able to get that up. You want to ideally be able to get that cap rate up within the first year and a half. And then you also got to make sure that you're well capitalized. If you're in a position where you're in negative leverage, say you don't get that same interest only period, and you might be losing money for the first year, or there's a chance you might be losing money. You want to be well capitalized to be able to weather the storm of not being able to cash flow and still be able to cover debt service while you get that value add strategy off the ground and get to that position of positive leverage. Second scenario where it's going to make sense is going to be special situations. For instance, we've seen a deal that we were looking at that we almost acquired that was it was a HAP contract. So a HAP contract is a housing assistance provider. I believe that is a housing assistance. Don't remember the exact acronym for it, but essentially, the housing authority was covering pretty much all of the rents at this property. So it was over 200 rents, and pretty much all of the tenants were having their rents paid by the housing authority. And this makes sense because in this situation, the housing authority had a rent schedule. So all the tenants, based on the floor plan, had the same rent, and most of it was being covered by the housing authority. And then they increased all of the rents at the same time. So we're going to a property where we knew as of January 1st for that following year, the rents were going to go up like 15, 20%. It wouldn't even need to be like a super strong value add. We're not guessing. We have an actual document from the government saying the rents are going to increase by X amount on this particular date. In a situation like that, looking at the T12, you're in a negative cap rate or negative leverage situation, but we have proof, and evidence, and documentation of these rents increasing at this set date, then makes us know we're going to be in a positive leverage situation very quickly. Now, the third case, which is a little more risky in my opinion, but may make sense if you really understand your market, is going to be a high growth market. So if you're in a situation where you can buy a property and you know the market is increasing very rapidly, it's going to be increasing to where the rents you're charging now, you're going to be able to charge higher rents in the very near future, or you're able to get just heavy appreciation and you're willing to weather the storm and bite the bullet because you want to buy that property at a lower cost now because you know it's going to appreciate. That would be the other situation. But again, these are going to be risky for the most part. The HAB contract, maybe not as much, but in general, when you're buying a property with negative leverage with the plan of getting a value increase, that can be a bit of a challenge. Note, added risk should be incorporated into the purchase price. A lot of times, brokers and sellers are going to try and sell you based on the pro forma, meaning like the projected value, meaning you're going to have to go in and do XYZ, increase rents, renovate units to be able to get to a certain value, and they're going to try and sell you based on that value. You want to push back on that and avoid that. You don't want to be double paying. You don't want to pay for a value that hasn't been created yet, and you're going to have to be the person that goes in and creates that value. The seller needs to pay the for that value or pay for that risk at some point. If you're taking on the risk of having to improve a property to get to a certain number, you don't want to pay for that and then have to go and execute on that. Just keep that in mind. So here are my final thoughts. Negative leverage should be avoided in most cases, but if you got an experienced team and you got a great strategy and a good asset, then it may be used to your advantage. Just make sure that you understand the risk and mitigate accordingly. All right, that's the end of this video. Thank you for watching. Please go ahead, like, subscribe, be on the lookout for the next one. And go ahead and leave some comments. If there's anything that you want me to discuss, or if you have any comments on just negative leverage and what cases may make sense, feel free to drop that in the comments. All right, until next time.